Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Now, Bank of Japan is in the limelight as they announced their policy decision today. Now, before the policy decision, there were a lot of expectations that BOJ might slowly start changing their stance, and that was a significant because for years investors have used cheap Japanese interest rates to borrow and invest elsewhere with a higher rate of return. Now, any big change to the borrowing cost might lead to a carry unwind. But it seems nothing like that has happened. They haven't changed their stance, or any major significant action has taken place. Good morning, JK. What's your take on the BOJ decision?
Good morning, Swaraj. So it's not only the US investors, but investors world over have used the cheap yen as a vehicle for investing into risk assets, and that includes India as well. Promptly, yen weakened after BOJ's unchanged policy announced a few minutes back, and it was not a surprise because they have been pushing backwards on the decision to change the policy from negative interest rate as well as to remove the yield curve control. So the day of reckoning is again postponed. Uh, I think it most likely will happen in the second quarter of 2024. Onto our market, it was not surprising to see importers use the dip in USD/INR below 83 to hedge themselves yesterday, and it's quite prudent as well because we have low premiums and a rare move of 0.5% in the spot rate that should have been taken advantage of, and that's what they did. While markets continue to enjoy their ride, there can be slowdown in the flows in the rest of the month that can keep things quiet for the rupee. Perhaps demand and supply well matched, so rupee can settle into a range once again, unless we have some big news or big flows. We also do not have many significant economic triggers till the end of the month when we will get a US GDP and PCE inflation numbers. Of course, before the traders sign off their Christmas holiday, we have the PCE inflation number actually preponed to 22nd of this month. So that's something that can have a small movement. And, markets have discounted inflation easing, Fed about to ease, and rate cuts in excess of 1% being discounted. And any uptick in the PCE core inflation number is going to be slight jolt to the market. And that, I think, the exuberance with which the markets have moved in the recent days, a correction is very much overdue. But yesterday, bond markets were actually almost flat, rangy movement seen in the near as well as the long tenor. Amid a number of central bank officials from US and Europe once again pushing against what they call extreme expectations of the markets on rate cuts. Chicago Fed President Goolsbee warned that the central bank has not pre-committed on cutting rates, and yes, it's very apparent. And Cleveland Fed President Mester said financial markets had got little bit ahead of the central bank with respect to timing and extent of interest rates. We also had the ECB member, Mr. Kazmi, saying the policy mistake of premature easing would be more significant than risk of staying tight for too long. So they would rather be tighter for longer rather than easing too early. And looking at the way things are shaping up in the Red Sea area, where the supply chains are likely getting affected and the oil price once again rising, these are risks that can always push the inflation higher. And central banks are aware that inflation having fallen from such highs will not further crash too much for them to ease in a hurry, and they would be very cautious about doing so. In another statement, Mr. Casimir also said positive drop in inflation observed in the past few months is not enough to declare victory and move to the next stage. So these statements obviously aimed at pushing back against market expectation, but markets still don't seem to be reacting much. Of course, stocks were subdued. Only Nasdaq was reacting higher yesterday. Yes, 7 weeks of continuous rally in the stocks, and that really was required to be halted for some time at least, or some consolidation was required. On the currencies, USD yen was the one to rally. We had seen just below 141 after Fed statement, and now we are above 143 after the BOJ rate decision. And that's the way yen behaves. Huge volatility that we have seen in yen. We had seen almost 152 last month, and now we are, after seeing 151, we were once again moving higher. On the euro side, it was slightly firmer, I think, supported by statements from ECB officials. Although the IFO number that came yesterday was once again weak, and the German business morale was worse in December, and it came at 86.4 versus 87.8 that was forecast by analysts. The institute said that the business climate index was revised downwards for November as well. It has already, downgraded the German growth to 0.9% from 1.4%. Euros continues to defy these negative data points, and just going by the yields and also the demand for euro on the crosses, like you have euro rising against the yen, against the GBP. So euro is just standing out with firmness, but I think year-end demand also could be a factor. But overall, I think it's only some flows that are going to determine the currency markets. So nothing more than that is what I feel. Only data of significance, as I said earlier, is the PCE core inflation and GDP number, which will come towards the end of the month. Rupee, I think we expect 83 to hold. Perhaps 83.20 will be the new top for now. Thank you.
Thank you, JK. And as Western markets go on a Christmas holiday, it seems slowly we are dying down of new data points. But during the month, we just have the PCE inflation numbers and the GDP numbers, as you mentioned. Now, yen, we can post the BOJ decision as BOJ continue to push against expectation of removing the yield curve control. And of course, we are seeing some slowdown in the data points, as JK also mentioned, as Western markets go on Christmas holiday. And there seems to be no significant triggers till the end of the month. Fed members in their speeches recently have been warning that markets are a little ahead of themselves when anticipating an early rate cut. Now that's an important development which we'll keep tracking. And USD INR dip below 83 was used by importers to hedge. And in fact, even the inflows into the Indian markets will be comparatively slower, as you know, as all of them go on a Christmas holiday. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.